Hi there, good afternoon. You're watching the Mutual Fund Show. I'm Mangla Malu. With me is Sumaira Abidi. She is in the Mutual Fund Corner. This is a show where we highlight and answer all your mutual fund related queries. Before we do that, a look at the markets. Well, not a good day of trade. It is a short week and the markets are seeing a bit of a sell-off. Any sort of positive commentary coming in with regards to, or positive triggers coming in with regards to lower oil prices failing to support the markets. It's the IT stocks which are trying their best as far as the bulls are concerned. So we have Infosys, Tech Mahindra, TCS, all of them currently at the high point of the day. But for the markets, our own markets itself, the Nifty is lower by around 84 points as we speak, holding above the 20-day moving average of 11,655. That is something we'll keep an eye out on whether that supports or not. 72 points on the Nifty on the downside. We have the Sensex not doing too well as well. And the Nifty Bank is the key culprit primarily on account of Yes Bank, which is contributing to the downside by more than 50%. Talking about banks, the big earnings that we are awaiting is Kotak Mahindra Bank, so we'll keep an eye out on that as well. First up, all the top stories, and then we hand it over to Sumaira. The market takes a knock despite positive global cues and lower crude oil prices. Financials led by Yes Bank and IndusInd lead the charge lower. Auto stocks too under pressure ahead of sales numbers tomorrow. Mid-cap index sees a big underperformance. The Yes Bank stock cracks following a dismal set of fourth quarter earnings. While brokerage commentary is poor, the management is confident of maintaining credit cost guidance of 125 basis points for FY20. Reliance ADAG stocks, they slide following ratings downgrade for Reliance Capital as well as two of its subsidiaries. NBFC stocks too hit on fears that the financing from mutual funds may fall. Oil prices dipped to $72 a barrel as US output is likely to make up for the shortfall from Iran. Shares of oil marketing companies rise. And with that, we hand it over to Sumaira. Sumaira.
Mangalam, thanks very much for that. Harsh Roongta of harshroongta.com joins in this afternoon to answer all our mutual fund queries. Hi Harsh, good afternoon. Good to see you in after a long time. And actually, we're seeing you on a day that once again, there are these fears that are rattling the market that perhaps, this fear of financing of NBFCs, what happens to mutual funds, etc. But how real is this fear that we could once again see a repeat of October-November?
See, I mean, you're talking of the possible defaults in the debt funds. So, I'm a former banker and I think anybody will tell you that when you are in the lending business, and the debt mutual funds are in the lending business.
Not really. Should be the investing business, right?
But investing in debt. So that's effectively lending. I mean, it's just a form of lending. I mean, the banks would do the mutual fund should do an equal due diligence while looking at the debt.
But are investors sounding worried to you?
Not really. I don't think so. I think... so most investors, and when we say investors, there will be various classes. And I think the retail investors clearly are not worried at this stage, at least, which is the same. And they should not be. I think for far too long, we have sort of assumed that that an industry that is investing in debt instruments to the tune of 7 lakh crores or 8 lakh crores, out of which I think 3 to 4 lakh crores is on corporate securities. There's bound to be default. And I think the fact that the defaults have been far and they haven't really been bunched up together, I think is good fortune. And
I would think that October and now April is not too far away, but nevertheless, we can debate it. And in fact, this is something that we'll be focusing on in our special segment at 3:30 this afternoon as well. But for now, let's get in some mutual fund investors who have queries about their portfolios. First up, a query comes in from Mr. Gopal Nanda, who also joins us on the call from Hyderabad. Mr. Nanda, good afternoon, sir. How can we help you?
Good afternoon, madam. Thank you for taking my question. Good afternoon, sir.
Good afternoon.
Go ahead.
Yeah, I'm investing in HDFC. My debt folio I'm sending, and I sent my equity folio also.
Okay.
The first question is regarding my debt folio. I'm investing in 3 funds: HDFC short-term debt fund and Kotak corporate bond fund. Recently added Axis, banking and PSU fund.
Okay.
I received a mail from the HDFC. There are the 0.2% of NCD charge from there is a Ranchi Express Highway, it seems. Habibagh Ranchi Express Highway.
Yeah.
This is parent unit is ILFS. So they downgraded from AAA to C. So my question is, so whether to continue in a HDFC short-term debt fund, my future investment also to be, they will be invested in the these Ranchi Express Highway. They won't invest because still the portfolio is showing that 0.2% of HDFC.
That would be the
Ranchi
existing investment, right? But since it is fallen below investment grade now, I doubt any fresh investment would be made, and I think bulk of portfolios have already marked it down to pretty close to zero, right, Harsh?
That's right. So I think anything that falls below investment grade rating is required to be written off. Then when an actual default happens, I'm not 100% sure whether the default has happened in this case, but the fact that it has fallen below BBB, which is the... in fact, every time it gets downgraded, the value will drop. Even if it gets downgraded from AAA to AA.
But the thing is, now that funds have already marked it down pretty close to... I mean, I'm not sure if HDFC...
must be pretty close to zero.
Yeah, it would be pretty close to zero. So therefore, does it make any sense to exit now?
So the point is, after Nanda, after you exit from this, what are you going to do with the money? The guarantee that if you put it in another fund, we will not have a sim in that. If you want to avoid all default, okay, the best is to put it in an overnight fund. Typically, overnight funds invest. I mean, it is investing in only bank and overnight kind of funds. I mean, you have overnight funds from. I think from a lot of people. You have an UTI overnight fund. I think you have a HDFC and SBI, L&T Cash. These are all overnight funds. These neither have credit risks, or I would never say there is no credit risk. There is very minimal credit risk, minimal interest rate risk, because every day.
Right.
So the NAV is very unlikely in an overnight fund. So if you really hanker for security, overnight is the way to go. Hold that, your post-tax returns from that better than a fixed deposit with a bank.
And in any case, if your portfolio has seen a credit event and it's been, I mean, it's your call really, but it doesn't make much difference whether you remain in or not, because your NAV would have been marked. Nanda, that's the advice for you, sir. Any further?
Yeah, regarding portfolio, I don't know, PNB Housing Finance, it is a portrated care agency, because some PAL is finance. So I'm worried about a quoted corporate bond also. Structured assets, they are having a more structured assets.
Mutual funds have the largest exposure to every other sector, and when, I mean, there's no credit event as such, it's their rating, which is currently AAA, has been placed on. We've seen even AAA ratings go from AAA to D, and is this also something that investors need to worry about?
So Nanda and other has a snowball now. Because you are afraid, you take an action, and because you take an action, the snowball gathers speed, right? And this is a self-fulfilling sort of a prophecy, right? I do not think you need to be worried. If you are overall worried about your credit exposure, okay, I would say move to overnight funds, okay? Or if you don't really, if you're not a high taxpayer, move to fixed deposits with good banks, right? If you're not, high taxpayer. If you're a high taxpayer, the fixed deposits don't really make too much sense. Move to overnight funds. He's already got one banking and PSU debt fund. He can move to others, where please remember, I want him and other viewers to remember that they carry an interest rate risk. Typically, the modified duration, the average duration of a banking and PSU debt fund can vary widely from like 6-8 months to 3 to 4 years. And larger that duration, higher is the chances that the NAV will drop if the interest rates go up. The drop is temporary though.
All right.